First of all, I mean, one unique thing about how this whole thing played out is there was this high-profile online conversation happening, dominated by high-profile investors saying in real time what they think needs to happen. Among them, Bill Ackman, who after the intervention said, our government has sent a message that depositors can trust the banking system. And that, without this confidence, he says, we're left with three, maybe four too big to fail banks. But the Startup Snapshot data, I mean, founders now in the wake of this are saying they don't have that confidence. They are still moving their funds to larger banks. So what's your take? Do you think that trust has been repaired?
Well, that's a very good question. I think, on a superficial level, the answer is yes, that Treasury and the Federal Reserve applied the same solutions to Silicon Valley Bank that they applied to the credit crisis of '08 and '09, and then again during COVID. And by that, I mean they used the Treasury Emergency Stabilization Fund, Economic Stabilization Fund, coupled with access to the Fed discount window as a way to backstop these banks. In the case of Silicon Valley Bank, what they did is say they created a new program called the Bank Term Funding Program, which allows banks to pledge securities as collateral at par. And the significance of that, of course, is that Silicon Valley Bank got into trouble because they had long-term, low-paying investments and short-term, ever-increasing costs of capital. The credit quality, it was really the issue. And so effectively what the Fed has done, not just for Silicon Valley Bank, but for all banks, is to say, don't worry, we're going to value your collateral at par, regardless of the economic reality of the situation, which is that after spending roughly $5.5 trillion, first addressing COVID, and then, the capstone was the Inflation Reduction Act, pumping all of that liquidity into the system necessitated the interest rate increases because of inflation. So, that part of the problem has not been solved. And so I think while, the Fed has put out this bank term funding program as a way to restore confidence in the banks, it doesn't address the more fundamental economic dislocation that is inevitable given the massive amount of liquidity that's been pumped into the system, coupled with a historically fast and steep rate of interest rate increases. We've never slammed the brakes on the economy in that way before, and we don't know what's going to happen.
So Dan, before we get a little bit more into the policy then, obviously there are many, and this is what we were just talking about, who say that the move has restored trust in the banking system, like what I referenced from Bill Ackman. But did the fact, that all depositors' money was covered, whether it was insured or not, could that precedent lead to any kind of reckless behavior down the line in thinking?
Oh, absolutely. It's a classic case of moral hazard. If banks can treat their investments as valued at par, what's the incentive to exercise sound management?
Yeah. So on the regulation end, you touched on this a little bit, in your previous answer. Up until 2018, there obviously were some regulations in place that may have impacted this. I think it's clear to everyone it's not the same thing. Nothing about this situation is the same thing as 2008. But SVB would have been subjected, am I wrong, to the Fed stress test, maybe some other sort of limitations. Do you think that would have changed the scenario? What has this taught us about the role of U.S. government, what the role needs to be of regulation in these type of crises?
Well, the change you refer to in 2018, S2155, if I recall correctly, was the culmination of a multi-year effort to reform or to repeal Dodd-Frank. Dodd-Frank was the biggest legislative package in the U.S. On financial services regulation ever. They revisited every federal law from the 1864 National Bank Act through Sarbanes-Oxley. They did it in a 14-month period with very little input from Republicans, which has made the whole bill and the rulemaking that stemmed from that highly partisan. And the Republicans spent 6 years trying to put the toothpaste back in the tube by repealing Dodd-Frank. Having failed at that, the closest they could get were really marginal adjustments, including raising the threshold for being considered a systemically risky bank from 50 billion to 250 billion. And of course, the regional banks lobbied in favor of that change. To my mind, the Silicon Valley Bank problem was first and foremost a management failure, right? They knew they had long-term, low-paying investments and ever-increasing cost of capital, and they did nothing to address that, potential insolvency. I think the regulators also failed, and the Federal Reserve Bank of San Francisco has announced that they're going to be looking at their examination procedures. So I think there is also an enforcement action. I don't know that legislative changes are even feasible in a closely divided Congress, but if there were bipartisan agreement on the need to plug a regulatory gap, I guess it's possible. But I'm always amazed at the extent to which, when a member of Congress gets caught in an ethics issue, for example, the first thing they want to do is change the ethics rules. Okay, this was bad bank management, which to my mind does not necessitate policy changes.
What does it necessitate, though, Dan? I mean, going forward, then, is there a way to prevent it from happening again, especially in light of what you just said, that yes, you think that this decision could actually make for more reckless decision making? I mean, what happens next, or what should happen next?
Well, a couple of things. First of all, the bank business model is dependent on opacity, right? This is not the classic capital market situation where you have full disclosure, so there's informed assumption of risk. In the banking sector, they don't want to disclose the risk, because if depositors knew how highly levered a lot of these institutions are, they'd probably want to pull their money out. And that's the role of the FDIC, is to give depositors confidence that they will get their money back. It's the modern day equivalent in the 1920s, when there were a series of bank runs. Banks started piling up cash in the storefront window as a signal to the depositors that we've got lots of money, your money is safe, don't worry about it. The FDIC plays the same role in today's banking system. Two thoughts on that. One is that Silicon Valley Bank was not sold over the weekend because the first order of business for the FDIC is to protect the deposit insurance fund. And because there were such a low percentage of the deposits that were insured, they circled the wagons around those deposits first as a legal matter. It wasn't until they decided that there were systemic implications that they brought in the Fed and Treasury to try to create this stabilization program. The other thing is that we've had a series of accounting changes going back to the credit crisis, around mark-to-market, where banks were not disclosing the assets on their balance sheets until the losses were realized under an incurred loss accounting model. Over an 8-year period, the federal and international regulators asked FASB and the IASB to move to an expected loss standard. So the current expected credit loss standard went live at the end of the year. It was opposed vigorously by the regional banks, who, of course, are not interested in more transparency that is absolutely essential to investors. So you've got that dynamic of sort of the transparency issues, the accounting issues on the one hand, and then you have just the reality that we have too many banks in the U.S. We have thousands of banks, going back to the sort of archaic limitations on banking across state lines, and so every state had to have their own banks, and that resulted in a proliferation of community banks. But there are economies of scale in banking that strongly suggest that there should be consolidation. Now, couple that with the concerns about antitrust, and so there's also a resistance to creating more big banks.
Right. So we're kind of talking about two sides of this key question, which is, on one hand, are we out of the clear on bank runs? Is there going to be a consolidation of banks? Again, from this survey, at least, founders are saying we don't feel so safe. We do want to go to the big banks. Do you think there is going to be a domino effect? Do you think that, we are going to see regional, local banks impacted going forward? I mean, are big banks the big winners here, bottom line?
The short answer is yes. Whether there is an additional bank run, I think, depends on whether there are new developments. What the Fed and Treasury have effectively done is put their finger in the dike. The question is, where does the dike break next? And that's impossible to predict. I think that they have solved the immediate problem. And, the same thing's going on in Europe with Credit Suisse, where they're providing liquidity and a cash cushion, and that has had a dramatic increase on the stock price. So I think the immediate problem of Silicon Valley Bank, Signature Bank, First Republic Bank, those issues are solved by the bank term funding program. But that does not mean the problems are over. I think we are at the front end of what is likely to be a rolling sort of crisis, if you will. So,
Dan, before I let you go, just one last question on that note. One of the key other takeaways of this current survey, in the wake of SVB, is that 59% of founders are saying they are looking to diversify funds, are going to kind of change their behavior. Understanding, as you say, that this is only the beginning, we don't know what kind of changes we're going to see going forward. Do you have any sort of tip or advice for founders, for these companies going forward?
Well, you can get much better return outside of the banking system right now, right? Even in a money market mutual fund, you're going to get, 4 or 5% return, and the banks simply are not paying that. The other issue that we haven't talked about that's worth mentioning is this concept of hot money, where venture capital and private equity in particular are highly interest rate sensitive, and they will move deposits if they think they can get a higher return. And banks that are dependent on hot money, deposits that are likely to leave quickly and all at once, we probably should have some reassessment of that hot money issue.
Got it. All right, Dan Crowley, thank you so much for taking some time to break down this issue. Obviously, not at all the end of the story.
Well, my pleasure. Thank you for having me.